welcome our market master for the day, Prabhat Awasthi, Head of Equities and Managing Director, India at Nomura Financial Advisory. Good morning, Prabhat. What a great time to have you on the show. 8,050 and still counting. Is this market, breaching all the targets that you experts gave it much earlier than you thought?
Well, I think, obviously, the situations, you can't really sort of say that things have changed positively in favor of India. So we learn, we learn as we live, sort of thing. We adapt as these situations change. Our target on a 12-month basis now is 30,000, which is still about 10% away from here, or slightly more. I think 12-13% on about 11-month basis, let's say. So we generally are still constructive. But clearly, I think there have been data points which give you reason to be cheerful about India. The growth numbers are definitely looking better than expected. The signs that the overall macro stability with the growth will work very much in favor of the market is clearly positive. And globally, I think India is looking very attractive in terms of both growth paradigm and also from the long-term structural policy perspective. So I think there is no reason to become structurally, negative or anything. You will remain positively biased over the longer term.
Your economist Sonal has called for 6% GDP growth this year, and if I'm not mistaken, is it 6.7 for the next year? Have you drilled it down into earnings growth? What have you revised your earnings growth forecast for the current year itself? Or is there a big bounce you're expecting in FY16?
Well, I think first of all, if you look at the earnings forecast for this year, they are closer to 15% growth, which is not really that much away from a 6% GDP growth. In fact, a 5% GDP growth will probably correspond to a 10% number. I'm just hypothecating because I would think a 5% GDP growth should mean 10 to 12% growth in top lines, which will not result in a 15% growth in general. So I think consensus forecasts are not way off the mark compared to 6% GDP growth. And that is because analysts continue to make changes in their forecasts as the numbers come on quarterly basis. I think they sort of continue to keep up to date. And the next year forecast could have upside, frankly speaking. But currently the numbers are closer to 16%. They could go up a couple of percentage points from here. But that is, still early days to sort of take a call on that. But if the recovery does remain as strong as we sort of expect, then there might be some hope for earnings in FY16.
Okay. Prabhat, hi, good morning. Good to see you. And as always, I was noticing your long only basket of stocks, and you made a lot of money in the last move. Look at the names. There's Havels, there's L&T, Maruti, Tata Motors, Dabur, all stocks that have been hitting new highs. How does one really position their portfolio? Do you increase weightage on some of these cyclical pockets like autos and capital goods, or do you still continue to hold defensives like IT?
So, I think, the portfolio construction is a matter of two things. I think one is the fundamental call that you have, and along with that, you have to balance the valuation picture. Now, while we generally are quite positive on India's prospects, we also have to recognize the fact that there are sectors which are also growing, which are not necessarily play on India. For example, IT is doing well because U.S. economy is picking up, and our expectation is that the volume growth will remain strong. And with respect to that, the valuations still do not look expensive to us. So that, I think, is a very clear call. It is a fundamental call based on what our analyst thinks, based on what we think in terms of the valuations with respect to the market. And therefore, we are comfortable holding IT here. If you see that, if you'd gone 1 year back, 1.5 years ago, and you would have seen a portfolio, we had IT, pharma, and consumer as overweights. And over a period of time, we have shifted that position completely in favor of domestic cyclicals, starting first with consumer about 1.5 years ago and then 2 underweight. So I think the portfolio does reflect a lot of positive bias for improving domestic fundamentals. But that doesn't take away the fact that there could be sectors which are not necessarily driven off India, which are still reasonably priced and may perform as well as the market going forward.
Okay. Well, the last auto numbers indicated that commercial vehicles have finally seen growth after a 15-month gap. Is that impacting your stock choices, including those who finance them?
Well, in some sense, I think commercial vehicles actually, Lata, I think are the best indicator of the economic activity on an incremental basis, because people are not going to buy trucks if they do not see demand for load that is going to be carried. So I think it is a very, very good indicator of the overall growth bias in the economy. And I think therefore, we sort of have become more positive in India growth based on the fact that we see these indicators turning around quite rapidly. And as time goes on, there will be more belief in the market. So it's not commercial vehicle financials alone which sort of matter to us. It is basically the overall economic activity in that context. I mean, what is commercial vehicle growth pointing to, or what is, for example, cement growth numbers or steel demand growth numbers pointing to a broad-based, stronger economic growth or economic recovery which is taking place right now in India. So obviously, if you start from there, then there'll be a number of choices you'll have, and it's not necessarily only commercial vehicles. It could be banks, it could be stocks like capital goods, etc., which may be late cyclicals, but if you've got valuation comfort, you can start buying them. So I think it's an overall recovery theme that we're playing, rather than saying that only commercial vehicles. Commercial vehicles are a symptom of a larger recovery process.
Okay, so just a follow-up to that, Prabhat, I'm going to put 3 stocks in front of you. Tell me which one has the maximum potential to give highest returns between L&T, ICICI Bank and Tata Motors.
Well, I think first of all, I personally do not comment on stocks that much because analysts drive the target. So I would say this, that totally different dynamics of these 3 stocks. For example, ICICI Bank is both a retail bank and a corporate bank, so it will be driven by both discretionary and non-discretionary demand. I think personally, our biases are more towards financials, because we think they're still cheap compared to history. Okay. So we like financials more than the other domestic recovery plays. Then Tata Motors actually not an Indian stock. I mean, we're positive on that stock, but at the end of the day, it is nothing to do with. About 10% of value comes from commercial vehicles. So, however positive we might be on commercial vehicles, Tata Motors, the main reason why I would ultimately end up buying Tata Motors is your belief in the JLR business, because that is what drives the value. And then obviously L&T is a late cyclical play, but it does benefit from a growth recovery. And it had fallen off a bit, I think, from the peak. So we sort of thought that it might be. So I think if you ask me, I think our favorite picks at this point in time still continues to be financials as a sector.
Okay. Well, Prabhat, would you say that mid-caps will grow much faster, give you much higher returns than large caps from now to the next 12 months, where you have your 30,000 target?
It's possible. I think if you really think about, I guess in mid-caps, one caveat is that there is no generalized mid-cap because there are too many stocks. So there are 2 ways you can get your returns again. One is the valuation recovery, which usually happens very, very quickly in a bull market for mid-cap. So the catch-up in valuations gives you first leg of returns. But if you're looking at a growth recovery, then obviously there will be play on growth, which will have to be differentiated between various sectors and stocks within mid-caps also. I mean, you can't say an IT mid-cap is same as construction mid-cap, for example. So I think now what happens in a recovery process is that for a company which is very large in size and has managed itself much better during a downturn, the upside to a recovery, I mean, obviously is there, but it will not be as strong as a mid-cap, or a mid-cap company, which mid-caps generally tend to get squeezed in poor economic environment. They have much more growth opportunity given their size and scale in recovery sort of environment. So if you ask me very broadly, like domestic cyclical sectors, mid-caps probably will have a better chance of showing strong growth for a longer period of time, given the size basically and the distress they have been through. So I think returns should be better. But as I said, it is highly, it is very important that people sort of look at stock by stock very carefully.
Okay, we have a query actually on our money control message board. So let me just toss that to you. Uday writes in to us from Ahmedabad, and he wants to know whether retail investors can invest in divestment candidates like Coal India and ONGC. So he wants to know whether it's a good call. What would your view be?
And PSUs in general, I think in a strong, when the government is strong, I think definitely are not bad choices to invest in. And if you do get a discount on valuation, then it's probably even more positive. So I mean, there is nothing wrong in investing in disinvestment, especially if you have a very strong government center which is looking at reforming the entire decision-making process across all spectrums of government, be it at the government level or at PSU level. So I think there could be value unlocking forward.
So your financials include PSU banks as well?
Yes, they do.
Okay. What would be the pecking order? Private banks, NBFCs, PSU banks in the financial space?
So we are actually more bullish in banks, Lata, compared to NBFCs. That is very simple, and I think within that we have a mix. So in fact, I mean, we like both private and public banks. I mean, you must recognize the fact that there has been an underwriting standard issue in PSU banks. Credit underwriting standards have been poorer, as the cycle has clearly proven in the last 5-6 years. So, but the valuations also gaps are there. So I think you have to balance between the two, and a mix is advisable. But also remember that in the index and in all indices, the weight of private banks will always be higher, given that they have much larger free floats. So even in a portfolio construction, we'll have always more weight towards private banks on a longer-term structural basis. And obviously, cyclically, I think PSU banks obviously can benefit a lot if the economy picks up, because the distress on asset side can shrink much faster and much more in these banks than for private banks, which didn't face that much distress in the first place.
Okay. Well, a very quick last question, Prabhat. I have a note of yours, which I am warned is an August note, but there almost all the buys you have are consumer buys, like Tata Motors, Maruti, Dabur, Havells to some extent, Just Dial, you've removed Titan, I guess. Would you be shifting to more investment or infrastructure-oriented companies now?
So if you look at the sector weights, I think, Lata, I'll give you a better picture.
Okay.
If you look at, for example, we don't have ITC, we don't have levers in consumers, right? So that basically is a big underweight on consumer. It's a huge underweight because you don't have the largest companies. Just having a Just Dial in there doesn't really make an overweight sector. So you might have a lot of stocks in there, but if you look at market caps, then it'll probably give you a truer picture of what we're trying to say here. Now, obviously, there is a discretionary demand pickup. Urban India has suffered a lot in the last 3 years or 4 years through a combination of factors. Slowdown is one of them. Agricultural inflation, MSP hikes, which actually impacted urban India far more. So there has been a fair amount of demand destruction or holdback in urban India. So you would tend to be more bullish on the prospects of a growth recovery when there is an industrial recovery taking place on urban India side. So it's sort of what you're seeing in Maruti essentially is a result of that. Havells is not really a consumer play. End of the day, it cannot be called a consumer play. They might be gaining market share, but end of the day, the application is very industrial in nature. So I would say that we have become more tilted towards industrials in this portfolio, but we are definitely not very bullish consumer compared to the market.
Fair point.
All right, Prabhat Awasthi, as always, thank you for joining us and giving us your view. And you have a great day, a great week ahead as well. That's the word coming in from Nomura. They have a 30,000 Sensex target by the end of August 2015.